Other capital budgeting decision models are the payback period. So the payback period is the length of time in years required to recover the initial investment outlay. When after-tax cash inflows are equal, then the payback period is the initial investment divided by the annual after-tax cash outflows. However, if the periods are unequal, then we have to look at the payback period as part of as we pay back each year. So we can't just divide it by the outflows when they're not equal. So in this example, we've just taken our after cash flows and used them to pay back that initial investment. And we can see that during year 4, we have recovered our initial investment. Strengths of the payback decision model are that it's easy to compute and that it makes sense to people. I understand that you're talking about how long it takes to pay back. However, it's just a rough measure. The longer the payback period, the higher perceived risk, but it doesn't really give us a lot of other information about if it's meeting our required rate of return. It ignores any outflows, so that those are our weaknesses. It doesn't consider any returns over the entire life of the investment. Once the investment is paid back, we ignore everything else. It also ignores the time value of money. It accepts or rejects projects based solely on if they can be paid back within a specific amount of time. We can also use the present value or discounted payback model. So in the present value payback model, then we look at the discounted model. So it must have a project net present value. So looking at this, we've used our weighted average cost of capital of 10% to discount our after-tax cash flows. Then we look at the present value of the after-tax cash flow and look at the payback for those. So we consider only the recurring annual after-tax inflows. The strengths are that we've included the consideration of the time value of money. The weaknesses is that it doesn't favor long-term investments, and it might motivate us to take on too many short-term investment. Any returns that happen beyond the payback period are ignored. Another model that we can use is called the accounting book rate of return, or the ARR, which is the average annual net operating income divided by the average investment. So we see that the operating income after tax, and then the average of that amount. So we have the book value of the asset at the beginning of the project, the end of project amounts recovered, and so our average book value over the life of the asset. So we would take that average annual net operating income divided by our average annual investment. So this gives us an accounting rate of return of 13.4%. However, some companies define the denominator of the ARR as the net original investment instead of the average investment. There are different ways to calculate this. If the accounting rate of return is calculated based on the denominator being the entire original investment, then the ARR would have been 8.53 versus the 13.14. So what are the advantages and disadvantages of the ARR? Well, advantages, we have the information already there. There's consistency between our data for capital budgeting purposes and data for performance evaluation. The disadvantages is that we don't use time value of money, and that the accounting rate of return relies on accounting numbers, not cash flows. So remember that our accounting flows in net income don't equal what the actual cash flows are. We also have behavioral issues in capital budgeting. So we might consider past costs or losses as relevant. So cost escalation. We escalate our commitment by looking at costs that can't be redone. So considering too many sunk costs as relevant costs. Then we also have incrementalism, which is when we take on a lot of multiple small investments instead of taking on long-term investments. This is also part of our intolerance to risk. So we might just be happier with those small, short projects because we're risk averse and the long-term projects make us nervous. We also have goal congruency issues. So are our goals lining up with each other? So our need to align discounted cash flows decision models with any models used for the financial performance at the end of the project. There are ways to address the goal congruency problem. We have three strategies. One is the use of the economic value added, or EVA. One is by separating incentive compensation from budgeted performance. So don't give bonuses based on our ability to make specific budgets. And the use of post audits or performance audits. So we also look at using spreadsheet templates for conducting a discounted cash flow analysis of an asset replacement decision. So we have this example where we're looking at a replacement decision for an asset. So what we're looking at is what are the different options as part of this replacement decision. So in the appendix, we have a differential approach. We have, but all three of the approaches that are shown in the appendix give us the same conclusion, that the net present value of the replacement equipment is $148,536, and the internal rate of return is 20.5%. So whether we look at a differential approach or an opportunity cost approach to our asset replacement problem, we still came to the same conclusion based on just financial measures of NPV and IRR. We also need to think about independent projects. So in yes or no situations for very independent projects, the NPV and internal rate of return methods generally lead to the same decision. However, there are some advanced considerations for the internal rate of return method. There are possibilities for us to have multiple internal rates of return. If at any time during the years of a project we have a negative outflow in the middle of a project, that can mess up the internal rate of return calculations and return multiple internal rate of returns. We might have mutually exclusive projects. And when we're trying to compare those net present value and internal rate of returns, it can be very difficult to do. Additionally, we have capital rationing. Capital rationing is a constraint put in during strategic and budgeting analysis that says only so much money can be spent on capital projects at any given time. This means that even though we've done all of this analysis, that all of these projects have positive NPV and say that we could accept them, our capital rationing tells us that we have to make decisions. We can only pick one or the other. So in the case of capital rationing, Then we want to base our capital budgeting decision making on the project net present value and not the internal rate of return. Under capital rationing, we would also look at the profitability index associated with each proposed project. So if they all had a positive net present value, then we would take the one with the highest profitability index. So the profitability index is the net present value divided by the initial capital investment outlay. So this is another thing to consider when we're looking at different capital budgeting projects and which one we should or shouldn't accept when we have a capital rationing issue, when we can't say yes to every project with a positive net present value. That is the end of chapter 12.